Hi everyone, this is Victor here. Welcome to the Intelligent Investor channel. At the time of making this video, the entire stock market is in a large bear market. The S&P 500 is down 16% from the most recent peak. The tech-focused Nasdaq index is down even more. It is down 27% from the most recent peak. If you're a growth investor, you may know that more than half of the stocks in the Nasdaq index are down more than 50% from their most recent peaks. In this video, I'm going to talk about these topics that I believe will help you go through this large bear market. First, how long does a bear market last? Second, why we are in a bear market and what are the causes? Third, why stay the course regardless of market conditions? And fourth, why cash cow companies are the best investments in a high inflation market? I will give you two examples. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all our members grow their stock portfolios to over 7 figures over time. With your support, we'll be able to stay independent, hire other outstanding analysts to cover different stocks, and create many excellent stock analysis and investing videos every week that will help you become a great investor. The link is in the video description. Take a look, let's start. At the time of making this video, the entire stock market is very fearful. Many investors are very worried that the US stock market will crash even more. Many investors are comparing the current bear market with the year 2000 dot-com bubble or the 2008 world financial crisis. The S&P 500 dropped nearly 50% during the dot-com bubble and 57% during the financial crisis from peak to trough. About 6 months ago, this fear and greed index showed that the entire US stock market was extremely greedy. Most US stocks were substantially overvalued. Now, this fear and greed index shows that the entire US stock market is extremely fearful. This means most stocks are oversold or even undervalued now. As a long-term investor, here are two important questions. How long do bear markets last and when will the bull market return? I found this excellent article explaining how long bear markets last. When we're in a large bear market, it is very important not to panic. We need to keep our emotions in check and be as rational and logical as possible. I always remind myself of this investment principle from Benjamin Graham. Benjamin Graham wrote this in his book, The Intelligent Investor. Investment is most intelligent when it's most business-like. It's amazing to see how many capable businessmen try to operate in Wall Street with complete disregard of all the sound principles through which they have gained success in their own undertakings. Yet, every corporate security may be best viewed in the first instance as an ownership interest in or claim against a specific business enterprise. And if a person sets out to make profits from security purchase and sales, he's embarking on a business venture of his own, which must be run in accordance with accepted business principles if it is to have a chance of success. Here's the important part. The first and most obvious of this principle is know what you're doing, know your business. Here are several things you must know about bear markets. Bear markets are normal. Bear markets can be very emotional and painful, at least temporary. There are different reasons for each bear market, but investors' emotions are always the same. Investors' emotions are always switching between greed and fear. Again, it's important not to panic in a bear market. It makes sense to sell shares of a company if your investment thesis in the company has changed, or if the company is no longer an outstanding business to invest in for the long term. However, it does not make sense to sell shares of a company if the company still has strong fundamentals, strong cash flows, good earnings, and great long-term prospects. No one knows how long bear markets will last. Here's the important part. Bear markets will eventually end. Bull markets will eventually return. So we should not worry about bear markets. Instead, we should take advantage of bear markets by keep buying shares of outstanding businesses. Be greedy when others are fearful and fearful when others are greedy. According to this table here, there were 3 large bear markets since 2000. The dot-com bubble in 2000, the 2008 financial crisis, also known as the Great Recession, and the most recent 2020 pandemic. During the dot-com bubble, the S&P 500 plunged 49% from peak to trough. It took the S&P 500 4.6 years to recover and reach the previous level. During the 2008 financial crisis, the S&P 500 dropped 57% from peak to trough. It took the S&P 500 4 years to recover and reach the previous level. During the 2020 pandemic, the S&P 500 dropped 34% from peak to trough. It took the S&P 500 only half a year to recover and reach the previous level. There were many bear markets since the 1950s. On average, the S&P 500 dropped 30% from peak to trough. off. In comparison, the S&P 500 has dropped around 16% from its most recent peak. Here's another important thing. Bear markets are usually much shorter than bull markets. Since the 1950s, it took the S&P 500 average of 1.7 years to recover from bear markets and reach previous levels. The worst bear markets were from 1973 to 1974, 2000 to 2002, and 2007 to 2009. These bear markets took more than 4 years to recover. According to this article here, there were 12 bear markets and 14 bull markets since 1932. The bear markets were on average 25 months or around 2 years. In comparison, the bull markets were much longer. The bull markets were on average 59 months or almost 5 years. This is why I believe it's important to stay invested regardless of market conditions. So why we're in a bear market and what are the causes? Each bear market is different. This is why I believe it's important to understand each bear market so we can take advantage of it. We're in a bear market mainly because our inflation is way too high. High inflation always leads to higher borrowing costs, higher interest rates, more monetary policy tightening, and eventually lower economic growth. Stock valuations also drop substantially when inflation is high because their future earnings and cash flows are worth much less in the present time due to high inflation and high interest rates. In my opinion, how long the current bear market will last mainly depends on when the US inflation starts to decrease and when the US Fed will start slowing its monetary policy tightening. At the time of making this video, the US CPI inflation is at 8.3%. This is near a 40-year high. The US PCE inflation rate is at 6.6%. This is much higher than the US Fed's 2% target inflation rate. There are many reasons that the US Fed is near a 40-year high. In my opinion, the biggest reason is that the US Fed printed too much money to support the US economy when the pandemic started in 2020. For example, between March 2020 and May 2022, the US Fed increased its balance sheet from 4.2 trillion to 8.9 trillion by buying US treasuries and mortgage-backed securities every month. This means the US Fed literally injected 4.7 trillion of money into the US economy in order to provide more liquidity for banks and to lower borrowing costs for consumers and businesses. No wonder our inflation is this high. There are other reasons that are causing our high inflation. These macro headwinds include the ongoing Ukraine war, rising energy prices, higher food prices, COVID lockdowns in China, ongoing supply chain issues, and chip shortage around the world. In my opinion, I believe the US Fed is well behind the curve in raising interest rates to reduce inflation. In a recent CNBC interview, the former Fed Chairman Ben Bernanke also believes that the US Fed made the mistake of delaying too long to raise interest rates to fight inflation. This is why the US Fed is raising interest rates aggressively now. As long as the US inflation rate is well above the 2% target inflation rate, the US Fed will continue to raise interest rates aggressively in the upcoming US Fed meetings. The US Fed will also reduce its 8.9 trillion balance sheet every month by letting its holdings of US treasuries and mortgage-backed securities mature instead of reinvesting them. This means we should expect borrowing costs for both consumers and businesses to increase much more going forward. In my opinion, the current US Fed's monetary policy tightening will likely lead the US to a recession over the next 2 years. According to the Wall Street Journal, during the past 80 years, the Fed has never lowered inflation as much as it is setting out to do now by 4% without causing a recession. So why stay the course regardless we're in a bull market or a bear market? Based on my experience investing for more than 12 years, I realized it's not possible to predict the market. For example, I cannot predict what the market will do the next day, next week, next month, or next year. Not many people predicted the Ukraine war. It will be very hard to predict when the Ukraine war will end. Hopefully, the Ukraine war will end soon. Since we cannot predict what the market will do next day, next week, next month, or next year, I believe it's important to have the right strategy and stay the course, regardless of market conditions. For example, my investing strategy is to invest in the best businesses that have large economic moats and increasing earnings over time, buy their shares gradually when they become undervalued, and invest in them for the long term. Personally, I like to invest in the best businesses that have strong fundamentals, large economic moats, strong free cash flow growth, and increasing earnings over time. Since I cannot predict the market, I like to buy shares of outstanding businesses gradually instead of all at once. At the time of making this video, the entire market is extremely fearful. This means many US stocks are oversold and likely undervalued. In my opinion, many US stocks are traded below their intrinsic values. The problem is that no one can predict when the market will bottom. This is why I believe it's important to buy gradually instead of all at once, and buy stocks only when they become undervalued. For example, I always use this intrinsic value calculator here to calculate each company's intrinsic value. I am planning to buy more Apple, Microsoft, Alphabet, and Tesla shares over the next 12 months whenever they become undervalued. They are my top conversion companies in this portfolio here. I believe they are outstanding businesses with strong fundamentals, large economic moats, increasing earnings, and increasing cash flows. In this high inflation market, I believe they can often pass higher costs to their customers, and their customers will still buy their products and services. I also have this portfolio account here. This account has done exceptionally well even in this bear market because I mainly invested in the best businesses that have large economic moats and increasing earnings over time. I bought these stocks here when they were undervalued. In this high inflation market, I believe it's very important to focus on the best businesses with strong fundamentals, strong free cash flows, large economic moats, and increasing earnings. I also believe it's important to stay away from companies that are not profitable yet and that do not have consistent free cash flows yet. Non-profitable companies are always impacted the most when the US Fed is tightening its monetary policies and when interest rates are expected to increase. For example, ARK ETFs mainly invest in disruptive companies that are not profitable yet. This is why this ARK ETF has underperformed the S&P 500 index substantially since the beginning of 2020. If we invest in the best businesses that are undervalued and buy gradually during bear market, we will benefit the most when the bull market returns. According to this research paper here, stocks lose 36% on average in a bear market. By contrast, stocks gain 114% on average during a bull market. In this high inflation market, I believe the best companies to invest in are what I call cash cow companies. Cash cow companies are the companies that have large economic moats that earn very large free cash flow growth almost every year. These companies can pass higher costs to their customers, and their customers will still buy their products and services. I will give you two examples here. The first example is Apple. In my opinion, Apple has a very large economic moat because most competitors cannot compete with Apple's iPhone, iPad, iOS App Store, and iOS ecosystem. Apple's biggest competitors are Alphabet's Android OS, Samsung, and all other Chinese manufacturers that make Android phones. If you look at Apple's latest financials here, you can see Apple had very consistent free cash flow growth over the past 10 years. At the time of making this video, Apple is the most profitable company in the world. It also earns the largest free cash flow almost every year. For example, in the trailing 12 months, Apple earned $106 billion of free cash flow. Apple also returns most of its free cash flow to shareholders through dividends and share buybacks every quarter. This is why Warren Buffett has almost 40% of Berkshire Hathaway's equity portfolio invested in Apple. Microsoft is another great example. Microsoft has a very large economic moat because many of Microsoft's products, such as Windows OS and Office 365, are near monopolies. Microsoft also had very consistent free cash flow growth over the past 10 years. At the time of making this video, Microsoft is one of the most profitable companies in the world. For example, in the trailing 12 months, Microsoft had $64 billion of free cash flow. Microsoft also returns a larger amount of free cash flow to shareholders through dividends and share buybacks every quarter. In a normal market, it's very rare for Apple and Microsoft to be undervalued. Most of the time, they are either fairly valued or overvalued in a bull market. But in a bear market, stocks are usually oversold. This means Apple and Microsoft are likely more undervalued in a bear market. If Apple and Microsoft become more undervalued in this bear market, I will buy more shares because I believe they are two of the best companies with strong fundamentals, large economic moats, increased earnings, and free cash flow growth. Now, all these are only my opinions and my analysis based on my research. They are not financial wise. There are always risks associated with investing. It's important to always invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting the channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.